Welcome, ladies and gentlemen. Welcome to the 2015 David Finch Lecture at the University of Melbourne's Faculty of Business and Economics. I'm Professor Paul Kaufman, Co-Dean of the Faculty of Business and Economics, together with Professor Seger de Graaf, who's here as well in the audience this evening. I would like to begin the evening in our customary way by acknowledging the Wurundjeri people of the Kulin Nation, the traditional owners of the land on which tonight's lecture is taking place. Tonight is the 19th Finch Lecture. Over the years, the faculty has developed the fine tradition of attracting to this event the world's leading economics and finance experts from academia, government, and international agencies. Since 1997, the David Finch Lecture has been given by renowned international speakers ranging from Jeffrey Sachs of Harvard, Stanley Fischer, then Deputy Director of the IMF, to Dr. Supakai Panikpati, Deputy Prime Minister of Thailand. Last year's Finch Lecture was presented by Professor Anat Atmati, Professor of Finance and Economics at Stanford. And tonight, I'm very happy to announce that this tradition of excellence continues. But first, it is appropriate to make some brief remarks about Mr. David Finch, in whose honor this lecture series is named. It is through Mr. Finch's generosity and foresight that we are able to hold this wonderful event every year. I would like to especially welcome members of David Finch's family who are able to join us this evening. Thank you for coming. David Finch was an alumnus of this university. He graduated with joint honours degrees in commerce and arts in 1944. In 1948, he completed a PhD at the London School of Economics. After a short time at the University of Tasmania, David Finch was appointed to the newly established International Monetary Fund, where he spent the rest of his working life. By the time he resigned in 1987, he was councillor and also director of the Exchange and Trade section of the IMF. His achievements were recognised by the University of Melbourne in 2000. 2 years before his death, by the award of an honorary Doctor of Commerce. I now invite Professor Jeff Borland to introduce our speaker for tonight for the 2015 David Finch Lecture.
So first of all, before I introduce the speaker, just on behalf of the Finch Lecture Committee, I want to thank the Faculty's Advancement Unit for the fantastic job they've done organising the lecture, and in particular Lauren Yu, who's done a great job with the organisation, so thanks very much. It's my pleasure and privilege to welcome and introduce the 2015 Finch Lecturer, Carmen Reinhardt. Carmen's the Minos A. Zombonakis Professor of the International Financial System at the Kennedy School of Government at Harvard University. Previously, she was the Dennis Weatherstone Senior Fellow at the Peterston Institute for International Economics in Washington, D.C., and before that, a professor at University of Maryland. At the start of her career, Carmen spent 6 years in the research department at the International Monetary Fund, so it's always especially nice when we have that connection back to David Finch. Carmen's known as one of the world's leading thinkers and researchers in the field of international macroeconomics, both for her contributions to economic analysis and public policy. She has a large number of publications in the world's leading economics journals. She is also notable for the many contributions she's made for writing on macroeconomic topics for general audiences. Her work, this time it's different, joint with Ken Rogoff, described on the cover here by Martin Wolf of the Financial Times as a masterpiece, analyses an extensive range of data sets that Carmen and Ken put together. And out of that analysis, they've generated a huge number of new insights about macroeconomic crises, which have really become seminal in the literature on macroeconomic crises in the past decade. And it's a work that's been hugely influential in the field. It's now been translated to over 20 languages, and it won the Paul A. Samuelson TIAA CRF Institute Award in 2010, as well as other awards. Carmen's received many awards over her career. Just in 2014, she was named as a Thomson Reuters highly cited researcher, and also by Thomson Reuters as one of the world's most influential scientific minds. In 2014, she was also awarded the Carlos Diaz Alejandro Award by the Latin American and Caribbean Economic Association. So it's wonderful for us to have Carmen here to present the 2015 Finch Lecture. Please join with me in welcoming her.
Well, thank you. It's a real honor and pleasure to be here. And I do think that there is more than beyond the love of international finance and macroeconomics, a connection between David Finch and myself having a long, not nearly as long as illustrious as his at the IMF, but having a long connection and an ongoing one with that institution. So I'm glad I've gotten to meet Mr. Finch's relatives. Well, without further ado, let me turn to the issues that I'm going to be covering. I have asked also to be told when my 10 minutes or 5 minutes are left, since I'm known to ramble, and I want to make sure that we have ample time for Q&A. I'll try to give sort of a brief tour of what I think is some of the big global issues at the moment. I'm not going to go through the genesis of the global financial crises. I'm going to really use this opportunity to take stock of where we are. Now, the crises was a worldwide phenomenon in varying degrees in 2008, 2009. Here we are several years later, and we are still not so much in Australia, because Australia blissfully was not in the core of countries that are still suffering the aftermath of this crisis, but we are still here. We are several years later, and some of the themes that I'm going to talk about with regards to the advanced economies, particularly in the case of much of Europe, is the issue of delayed recovery, deflationary tendencies, and their debt overhangs. And these debt overhangs are not just about public debt, but importantly also private debt, household debt, domestic debt, external debt. There is an issue that the natural question to ask is, how will it end? And here, I will rely on some historic experiences to discuss this issue of what may lie ahead in terms of the resolution of the debt overhang. In terms of global finance, I think there is a great deal of discussion in the media on the question of why are interest rates so low? Why are real interest rates so low? Why are we seeing several years after the crisis an unusually prolonged period of negative real interest rate, that is nominal interest rates minus inflation, being persistently negative? And with emerging markets, just by way of background, unlike the 1930s, let me backtrack. I think I would assert, and many would agree, whether they're historians or not, that the 2008-2009 crisis was the most severe financial crisis since the 1930s. Unlike the 1930s, however, it was not as synchronous. That is to say, the crises hit the US, hit the UK, and hit much of Europe. I say much because the Scandinavian countries were not part of the countries hit by the crisis, but emerging markets and among the advanced economies, Canada, Australia, New Zealand, and Scandinavia were the ones that avoided the crisis. So my last point of discussion is going to be, again, in taking stock, is where are also in this global picture, after I talk about what some of the big issues are, particularly with Europe, where are emerging markets in the current environment. Now, as to the question of where the advanced economies are 7 years after subprime, the answer is a very disappointing one. Ken Rogoff and I looked at the 100 worst crises since the 1860s, worldwide, advanced and emerging. And we looked at very simple measure of the severity of a crisis. That is, how big is the decline in output and how long does it last? We ask a very simple question. How many years does it take to get back to your per capita income level before the crisis? So we're not even talking about more elaborate measures of recovery, such as, when do you get to potential output? When do you reach full capacity? All we're asking is, how long does it take to get back to where you were before the crisis? So this is a minimal minimorum definition of recovery. Now let's just take stock here. I'm not going to talk about the US crisis of 1893. There was also a major crisis here in Australia in 1893. 1893 was not a great year for a number of countries, but just to illustrate how we define severity. We look at severity in two very simple ways. The magnitude of the decline in per capita GDP, that's the peak to trough decline, and then the number of years from peak to ultimate recovery. So where are we? Let us say that if what I'm discussing here with you is based on the International Monetary Fund's latest World Economic Outlook projections that go out to 2020. I do not do projections. These are the International Monetary Fund projections through 2020. And of 12 countries that had very severe systemic banking crises from 2007 to 2009, from a dozen countries, only 2 countries, the US and Germany, have recovered to their pre-crisis level. And if we ask, this is perhaps a little hard to read table, but let me just highlight what it says. The last column, which is the one that I'd like to call attention to, basically takes International Monetary Fund projections for these countries, including, of course, the actual data up through whatever is available for 2015. And we show the year in which per capita GDP gets back to what it was in 2007 or 2008, depending on where the peak was. So for Italy, for Greece, even by 2021, according to IMF estimates, they are nowhere close to the income levels that they had in 2007. So the concept of a lost decade is not just a concept, it's looking a lot like a reality. If you look at that bottom row here, almost the bottom row, it says summary. You'll see that if these forecasts are anywhere close to right, it will take 10 years, 9.9 years, for these countries to get back to their income level per capita from the financial crisis. Now, is this good, bad, indifferent, or how does this factor in with comparable episodes? Well, Ken Rogoff and I, in a fairly recent paper in the beginning of last year looked at the worst 100 crises between 1860 and the present. And the median duration, the median number of years it takes to get back to the pre-crisis per capita income is 6.5 years. The average is 8 years. So these crises, which are, to reiterate, in advanced economies, if they haven't been among the worst in terms of the magnitude of the output decline, they are certainly among the worst in terms of the duration of time that it's taking to get back to where we were. Along the way, this protracted period of sluggish economic activity, if not outright contracting economic activity, has been associated with a very high incidence of deflation, particularly in Europe, which continues to this day. The idea that countries like Italy, Greece, Spain would simultaneously have a deflation problem is also not something that one would have thought of in the context of modern day economics. When you really have to go back to an earlier century to look at, outside of Japan, such a sustained period of deflation. So why am I talking about the incidence of deflation and the incidence of sluggish, subpar recovery? Well, we have to, if we want to understand how this may all end, we have to ask what has made this crises so protracted? What has made it? I know it's difficult to grasp this issue as a reality here in Australia because Australia is among the countries that had a very, very, like across the board in 2008, 2009, there's a very strong hit on the economy, but then a fairly strong and rapid recovery. But this has clearly not been the experience elsewhere. So we have to ask, what factors have made this crisis so protracted? And I would highlight a list that says, well, like in the 1930s, the crises occurred simultaneously in a lot of countries. So there was synchronicity between the crisis in the US and in Ireland and in the UK and in Italy and in Spain and so on. I would also add to that, which I don't think any of this is vaguely controversial, the fact that within Eurozone countries, the ability to allow the exchange rate to adjust, to regain competitiveness has not been there. One has to wonder, of course, whether the adjustment in Spain or in Greece or in Ireland would have been a lot faster had they been allowed to have a significant depreciation in their currencies. But the factor that I'd like to highlight is that since the crises in these countries, what we've seen is lack of credit. That is to say, there has been very little bank credit available to finance economic activity. Even working capital has been an issue. The dearth of credit has been very, very significant. And at this stage, 7 or 8 years, depending on the country, 7 or 8 years later, there's still a lack of deleveraging in these economies. Now, I'm going to show 3 charts that highlight the debt overhang problem that I've been trying to argue is an important factor in this delayed recovery. And the dimensions of indebtedness are not just, it's not a public sector issue, it's a private sector issue as well. This is, what this chart shows here is domestic credit, importantly a lot of household credit across the period. And what we see is, even after 7 years, limited deleveraging. By contrast, if you look at the big crises in the Nordic countries of the early 1990s, what you had seen 7 years later is already much sharper deleveraging. The same picture I'm going to show you, now moving on from domestic private credit, I'm going to talk about external debt, both public and private external debt. That's the next chart. Similar story, big, huge buildup in debt before the crisis, and only limited deleveraging after the crisis. And if you want to look at very rapid external deleveraging after a crisis, you can look at the Asian crisis and see that indeed, 6 years after the crisis, the Asian economies had levered much more significantly than anything we have seen in the current crisis. And then public debt, finally, as a percent of GDP, is at its highest levels since World War II. Now, let me be very clear, and this is something to take into account when one looks at, for example, the current Australian situation. Ahead of the crises, ahead of the 2008-2009 crises, Ireland's debt to GDP ratio was around 30%, and Spain's was not much higher. These countries did not have a lot of public debt. What they had, it was a lot of private debt that after the crisis became public debt. And that's a recurring feature of crises. Very often when you see these big buildups in public debt after a crisis is the government sector largely assuming much of the debt that the private sector had before the crisis. And that also helps explain why public debt took the surge that it did. I'm not going to go through this list, but I want to highlight that ultimately these large levels of public and private debt are going to wind down, and the question is how. And I think that thus far, the official approach has been saying, well, you do structural reforms to try to get growth, and you do austerity. For years, I have been arguing, and in writing, that when debt levels are that high, those two things, as necessary as they may be, may not be enough. In other words, you need more tools to reduce high levels of debt. One such tool has been around forever, which is explicit restructuring. I don't think we have seen the last of the restructurings in Europe. And I don't mean just Greece. Hopefully what I will show is that, and convince you, there's a new study at the IMF by Arsenal et al. That looks at who holds the European debt. And what has happened in recent years is a lot of that debt has shifted from being in private hands to being in official hands. So the debt is held by the IMF, it's held by governments, it's held by official institutions, which also makes restructuring more of a, perhaps a less messier process than the kinds of restructurings we've seen in notorious cases like Argentina, 2001, literally to the present. So I think restructuring is something that's going to be in the picture. I also think that, and this is a controversial term, the use of the word financial repression, which I did not coin. This is a term that's been around forever. The late Ron McKinnon introduced the concept, but I think all it really means is a combination of much more regulated financial markets, which create more of a captive audience for government debt, especially in Europe, but also we've seen that in the US, and persistent low interest rates, i.e. that result in negative, real inflation-adjusted interest rates, which is essentially, to be very clear, a negative real interest rate on a bond is a tax on the bondholder. So it is a quiet, more opaque form of taxation. And I think those are factors that are often sort of left out of the discussion, and I think they're factors here. And to, how am I doing on time? Just, What? 20, very good. No, because as I said, I have a lot of material and I want to make sure that I don't end up babbling at the last minute. So the study that we recently completed looked at precisely this question: how in the past have these big debt overhangs been unwound? And what we highlight is that if you look at the strictly orthodox approaches, i.e. you grow more and you run primary surpluses, these were certainly big factors in debt reduction. But the way to read this is in 59% of the episodes of significant debt reduction. To reiterate, in 59% of the significant debt reduction, inflation was higher than the median. Real interest rates were lower than the median. And in 23% of those episodes, there was explicit debt restructuring. So, and this is for advanced economies. If we bring in emerging markets, I can assure you that the proportions in those last three columns would increase very significantly. But let me continue with so if you humor me and you say, well, there may be reason to believe that after 7 years relying more on structural adjustment and fiscal austerity in the international community is beginning to perhaps be a little more adaptive to the fact that other measures may be required. I would say that this is very relevant to the big discussion of the question, how long is quantitative easing going to last in the US? How long is quantitative easing going to last in Europe? My own expectation is that to answer that question, and I will try, I don't do forecasting, okay? I don't, but just from a historical perspective, I would argue that the tendency for central banks in the United States, the Federal Reserve, and the ECB in Europe, and the Bank of Japan, are the tendency to prolong the low interest rate environment and to be very moderate in both the speed and the magnitude of interest rate increases. I believe that to be my baseline scenario for this very reasons that I tried to convey. If you look at any level of indebtedness, it's very high. Debt, high public and private debt are not the kinds of economic setting that would receive high interest rates or sudden interest rate spikes well. In other words, I think that if you look at this long history of interest rates, it is not a coincidence that the periods of very low interest rates, low real interest rates, i.e. low real interest rates meaning interest rates below zero, in that the zero line is, you see right there, those periods were periods of very high debt. Periods of high debt after World War I and periods of high debt after World War II. And so the combination of sluggish recovery, deflationary tendencies, excess capacity, and high levels of public and private debt, in my mind, translate to a prolonged period of accommodation by the major central banks. And this is part of that overview that I wanted to provide. Let us also say that there is historical antecedents in that, and very recent studies showing that even modestly negative real interest rates create big fiscal savings at a time in which it's highly needed. And my last point on real interest rates before I turn to emerging markets is from a recent paper that I did with a former student of mine, Belén Sprancia. What this chart shows is the distribution of real interest rates, treasury bill rates, from the period 1945 to 1979, 1980 to 2007, and 2008 to the present. And the point being made here is that our recent experience, i.e. that last column and the solid red line, shares much more in common with the post-war experience after the debt overhang of World War II than it does with the very liberal, globalized financial markets of the 1980s. And that the incidence of negative real interest rates in advanced economies, this is, again, for 22 countries. I'm not looking at just the US or just the UK. These are for 22 advanced economies. The incidence of real interest rates is high and, in my view, likely to remain high. Now, let me turn to the issue of emerging markets. So, what has the post-crisis era meant for emerging markets? Well, in 2008, 2009, the global financial crisis had a very produced a very significant and sharp downturn for emerging markets, but one that they quickly recovered from. And the reasons why emerging markets were the very attractive hotspot or vehicle for Wall Street was not difficult to find. Emerging markets in the period 2004 to 2013, with the exception of 2008, 2009, global economic financial crisis, emerging markets were facing low and stable international interest rates, in many cases declining. Emerging markets were facing very high and rising commodity prices. Emerging markets were benefiting from very rapid double-digit growth in China, and particularly high levels of investment in China, so that many of the primary commodities in mining also had a huge impact on the economic activity. What we saw is a period between 2003 and 2013 of generally above average growth, especially among the primary commodity producers, and in general, a very favorable environment. Now, one of the areas that I've written a lot over the course of the years is on these capital inflows, capital outflow cycles, that during the boom years, you are attracting capital. It's very easy for countries to borrow abroad. It's a very favorable environment for finance. And during that bonanza phase, bonanza in the sense of booming commodity prices and bonanza in the sense of large capital inflows, what we also see is that internally, credit booms begin to emerge, asset prices begin to increase, and economies sometimes overheat. So the end of capital flow cycles is often not a pretty one for emerging markets through much of history. I'm not going to go through the details here. This is not the venue to do that, but what I've just said actually is based on work that looks and asks the simple question: what is the probability of a banking crisis at any point in time, the unconditional probability of a banking crisis, and then compares it to what is the probability of a banking crisis given that the country just had a large capital inflow lasting for about 3 years. And the odds of having a banking crisis, the odds of having a currency crisis are much greater following a bonanza. And that's where we find a lot of the emerging markets are placed now. Before, by May of 2013, when the so-called taper tantrum took place, when the Fed announced initially announced its intention to taper quantitative easing, by that time already, current account deficits in many emerging markets had begun to reappear. They had gone from surpluses to deficits. Many of them had had credit booms. Many of them had shown signs of currency overvaluation, and growth had already begun to slow. Now, under those conditions came quantitative easing, slotted to be unwound or gradually reversed. In that environment, commodity prices declined further. China's slowdown intensified. Global investors also began to shift away from a lot of emerging market fixed income to equities in the advanced economies. And last but not least, the recent, and this is not a trivial point at all, the recent sharp appreciation in the US dollar has increased the weight of debt servicing for countries that borrowed in dollars, in US dollars. And this is most of the emerging markets. So the issue of a heavier external debt burden is also connected to the sharp increase in the dollar. Just to make the point that this is what I have been referring to as the bonanza period, and this is the undoing of that bonanza. This captures at least the commodity price dimension. The other dimension that I've alluded to is one cannot underestimate in the current environment both the direct and the indirect effects of the Chinese slowdown on the world economy. The direct effects obviously is the fact that the share of China in the world's economy has increased quite significantly. That's the direct effect. The indirect effect is twofold. One is its increased trade with much of the emerging world, and it's also the impact on commodity markets. And so, to recap, on the emerging market external indicator scorecard, I would argue that, and this is the view that I'm presenting here in the following dimensions, has very little controversial or sort of unique flavor. I think it's a very standard, recognized set of vulnerabilities that, the commodity price reversal, the slowdown in China, the rebalancing in China from investment to consumption, and the possibility that at some point, in some magnitude, rates may rise are all external factors that are making emerging markets more vulnerable. What I'd like to do in the remaining time that I have is to talk about, well, what are the possibilities if there are factors that we do not understand as well that may also work to slow down emerging markets. And what I'm showing in this chart is that if you look at private domestic credit as a percent of GDP, China's share, which has increased very dramatically, and this is what we see. More important in the case of China's internal debt is not what we see, is what we don't see. But sticking to what we see, which is the domestic credit as reported in the IMF statistics, China's domestic credit is not out of line with countries that have already had significant systemic banking crisis. That is to say, if you look at the number of countries above the line, above China, most of those have had already banking crisis. So the question that I would pose is, are there missing ingredients that we're not seeing in the global financial system now as regards emerging market sources of finance? And let me translate that, hopefully, into the English language in a moment. When we talk about China's growth having had major impacts on emerging markets, I was quite aware of it from the trade side. What has been most surprising to me recently is that along with the growth in trade, in goods and services, there's also been a growth in finance. That is to say, China has been lending to emerging markets over this period in increasing amounts. And I think one has to ask the question, if China does have a harder landing, one can ask the question, are emerging markets in for a sudden stop in financing that has less to do with conventional international factors such as international interest rates and commodity prices, and more to do with a new source of financing that perhaps is in the process of drying up? And that is food for thought. I do not have, I do have evidence that these sources of financing have increased importantly, but I think that's one area of risk for emerging markets that is there now that was not there before. Another area of risk associated, that's sort of a conglomerate of all the factors we have been discussing, and a few that we haven't been discussing, is this last picture, and this is my last picture, of the share of emerging markets which have current account deficits above 3%. There is nothing magic above 3%, okay? I could have used this graph with 2%, I could have used it with 4%. I'm just using a I'm just using the 3% to make the point that current account deterioration has been an increasing problem in emerging markets. And not to mention the work that I've done with Ken Rogoff on the issue, but rather my earlier work of 2 decades ago with Graciela Kaminsky on early warnings of financial crises. Current account deficits are usually an indicator of potential future banking and currency problems. So on that uplifting note, in which I would argue that apart from the obvious, there's also less obvious reasons why there should be some concern about whether the next round of crises is going to come from the emerging markets, which have been very quiescent since the last major crisis in Argentina and Uruguay in 2001 to 2003, whether that era of greater emerging market turbulence is not what lies ahead. I find it a bad indication that emerging markets are inviting me more to visit and to talk, because during the very high growth, prosperous period, there was less interest, since I am possibly associated with financial crisis, although I make no claims to cause them. Let me stop here.
Thank you, Carmen. That was absolutely wonderful, and continues the proud tradition of the Finch lecture. I'm sure that this has provided plenty of cause for questions. So we invite you to raise your hand. One of our roving mics will move in your direction. If you could keep your question shortish, that would be welcome. And if you could identify yourself as well, that would be great.
Yes, Professor Reinhardt. I'm an anthropologist here at Melbourne University, and a lot of my work deals with the environment, and I was wondering whether you could touch on the ecological crisis. The World Bank has recognized the severity of climate change, and a number of people argue that the global economy is actually driving the ecological crisis. The growth paradigm is driving that, so I don't know what your reading is, but I'd like to hear about it.
Well, let me first answer very honestly, which is I am far, far from an expert. That is to say, what I will have to say that is of any intelligence or information is quite limited on the subject. But let me just put in one seed of doubt with the unambiguous connection between growth and environment. And that's all that when financial crises hit and growth contracts, with the growth contraction, which one might think other things equal, might have some positive consequences from the environmental standpoint. One of the adverse effects of financial crises is that you have fairly indiscriminate cuts in government spending and government investment, and sometimes the push to get extra export revenue leads to more desperate methods of production that would actually be going in the opposite direction of helping the environment. So what I am getting at is that a nice growth slowdown may have positive consequences for the environment. I am not sure that swift and sudden contractions associated often with financial crises do. I think adverse consequences on investment decisions and export decisions and so on are often part of those crises. So, but again, take my apologies for not really being able to give you a better answer, since that's really not an area where where I have, focused my studies.
Question there right in the middle. You can get that, Laura.
Thank you for the talk, Professor. I have a question. In the media, you hear that the U.S. economy has recovered, and in the charts you show that income is back to normal in the United States. But I'd like to know, given the fact that the U.S. supposedly can't take real interest rates higher than zero, how fully is the economy in America recovered?
So your question is being debated up and down. What I'm about to say is not, confidential in any way, shape, or form. These are part of open discussions. I am part of the advisory board of the New York Federal Reserve, and so this is all in full disclosure. The issue of has the economy recovered enough that it can withstand increases in interest rates at this time is a major source of confusion for the authorities, meaning for the Fed. If you look at the first half of this year, U.S. indicators were unambiguously weaker, especially the first quarter. So there is a true sense of confusion to what extent. Yes, if you look at the unemployment rate has been going down steadily. Part of that also, it is widely known that it's declining participation rates. If you look at certainly income on a per capita basis, it's more than fully recovered its original level, but growth rates have remained modest by any recovery standard. So in connection with what is the Fed, what is the next, there is a lot of confusion of what the first half 2015 numbers mean. And my own expectations, and this is just my own expectation, is that caution may prevail, meaning that the tendency would be to move slower and move more gradually. I know the Fed has been pre-announcing, this is like Gabriel Garcia Marquez's Chronicle of a Death Foretold, that we've been announcing that this is gonna happen and this is gonna happen, but I think there may be, that any move on rates, because of uncertainty about the magnitude of the recovery, may be delayed into late this year or early next, rather than the fall. That's my own expectation.
Professor Reinhardt, thank you for a great lecture. There was a little coverage a while ago with the Swiss franc being decoupled from the euro.
Yes.
Do you have any specific comments about the reason for that and the implications, please?
Let me backtrack first to the second part of your question on the implications and then for the reasons. The implications, when I've talked about emerging markets, I really had skewed my discussion more to Latin America, Asia, Africa. I hadn't said much really about Eastern Europe and Eastern Europe is emerging Europe. The impact of the very sudden and sharp rise in the Swiss franc for Eastern Europe has a lot of parallels with a very sharp rise in the dollar and the impacts that I alluded to, in that if you're Poland and you have foreign currency debt denominated in Swiss francs, you've just had a very sudden increase in your external debt burden as a consequence of the rapid, and in Poland it's actually even more than that, because a lot of domestic debt, mortgages, are linked to the Swiss franc. So that's not good news from the vantage point of emerging Europe. That's in some of the effects. The why it happened, I think, Switzerland, when the crisis hits Europe and Germany recovers, is really the first country to recover. They were not in the same cycle as the UK and the US and Spain. And they're the first to recover. And One could only speculate what, had there been a Deutschmark, how much it would have been appreciated. Instead, what's happened is that currencies of the countries that did not have severe systemic crises, Switzerland, and also the Nordic countries, began to appreciate significantly. And it was in an effort to stem that significant appreciation that the Swiss decided to peg, which was a pretty extreme decision after having been, committed to a floating exchange rate for a considerable amount of time. My sense is that at some point the cost for Switzerland of having a pegged exchange rate and accumulating reserves, the cost of, trying to lean against the wind became quite significant, and that's why they decided to abandon the peg. And, let me be concrete. What do I mean by the cost of accumulating reserves? Well, if the central bank, if the Swiss National Bank is trying to avoid an appreciation, they're buying foreign currency debt, but that also means a monetary expansion, which could fuel in turn a credit expansion and possibly create issues, in terms of a credit boom of dubious quality. So I think that after a period of leaning against the wind for an extended time, they decided it had been enough. But I am concerned about the implications of that for countries that had taken on Swiss-denominated debt.
Two more questions, one there before we move back to Ivory.
Professor Reinhardt, my name is Rashad Hassanov and I'm third-year PhD student at Deakin University. My PhD thesis is on financial crisis, and I would like to take this opportunity to thank you for inspiring me for this topic. I've got probably 10 papers of yours in my reference list. So, and also thanks for helping out with the data request. That means a lot to me. You've replied a couple of my emails. So my question is on resolution, the role of the governments in resolution of financial crisis. Particularly, I'm interested in the role of sovereign wealth funds in the oil exporting countries. What are your thoughts on the involvement of these funds from the sovereign wealth funds in the giving stimulus to the economy or in the resolution recovering from the financial crisis? Thanks.
So, look, in terms of, there's the issue of what you do during the crisis, and then there's the issue of what you do in the later stages. I think during the height of a crisis, during the period of extreme turbulence, i.e. the equivalent of a 2008, 2009, if you ask about was the policy response of fiscal and monetary stimulus the appropriate response, I would argue unambiguously yes. I cannot say we know what the counterfactual would have been, and I'm glad we don't see the counterfactual. The question of what you do after if growth isn't restored is a much more hybrid one. Because, and I'm not dodging your question, I think when I put up the slide that says, well, here's the menu of possibilities, and whether you do more restructuring or less restructuring or more financial repression or more austerity or you do more structural reforms is going to depend a lot on your initial conditions. Normal toolkit to deal with business cycles is not the normal toolkit to deal with financial crises. And the more severe financial crises actually call for a much broader toolkit than sort of the traditional orthodox monetary/fiscal responses. But did you have a particular episode or question as to a particular,
Just interested in the role of the sovereign wealth funds and to see if it could be the resources from there could be used as a stimulus.
Which I just couldn't hear, I'm sorry.
So I'm more interested in the oil exporting countries.
Right.
They've got like billions of dollars in their funds that.
Okay, that part I missed, I'm sorry. Okay, look, if the sovereign wealth funds do their job, then this is the time we will be seeing their benefit, right? I mean, given what has happened with oil prices. A chronic problem, I'm sorry, I had missed that part of your a chronic problem with, a reason why we keep having financial crises, in my view, is that the seeds of crises are sown in the good times. That is, during the booms, you don't save. And because you don't save during the booms, during the bad times, you have to impose all kinds of tight austerity, both on the sometimes monetary, sometimes fiscal, sometimes both, that you would not otherwise had you saved more in the good times. So to the extent that sovereign wealth funds really have used the bonanza period, it is in my view, is a very much needed precautionary tool. I do think that the issue of, is this a good time to rethink fixed exchange rates with regards to oil producers? This is more of an issue for some of the more marginal oil producers, namely the Venezuelas, the Nigeria. Is this a good time to rethink fixed exchange rates? That may be so. So that the adjustment on the exchange rate score really depends on whether you have the reserve pool and you have the savings, and some oil producers clearly do not.
And last question, over there.
Professor Reinhardt, a question following up on your discussion about the likelihood or unlikelihood of another banking crisis soon. According to one estimate, there are $14 trillion worth of corporate junk bonds circulating globally. 9 trillion of it is in the developing countries, which you already talked about before. But 5 trillion is mostly related to energy exploration and production and drilling companies. Much of it is in the U.S. fracking companies, which is one of the most highly geared industry in the U.S. Mm-hmm. If even 10% of that $14 trillion go bad, wouldn't that be a much bigger thing than our subprime crisis in 2008, 2009?
The risk you pose is very pertinent, very relevant, and one that could also have sharp impact on investment and economic activity. The question is, does it have the ripple effects and the repercussions of a subprime? And my answer would say no. And the reason is it's more localized. When you're looking at the housing market in the US, you're really, I mean, one of the things, there are two ways I would address your question. One is, if you look, the IT bubble in the US, the dot-com bubble burst, but it had no major, it had some systemic, it had some economic effects, but no major systemic effects. It didn't involve the leveraging of the corporate sector at large or the household sector. It did not certainly involve the government sector. Now, the vulnerabilities in the oil industry, if assuming oil prices there don't recover, and they're there, the potential for bankruptcy within those firms is clearly there. But what I would argue is that the balance sheet effects, if you look at the flow of funds of the United States and you look at the relative size of what the mortgage pool was and the relative size of what borrowing by these firms is, they're very different, both in scale, in concentration, and also its implication for the major financial institutions. So I am not downplaying the risks that it could mean, another downturn in investment with its impacts on economic activity, but I would argue that the scope for a systemic a la subprime mortgage is not of that scale. That's my assessment.
That's good to hear. So, Professor.
At least I have to say something positive.
It's been an absolute privilege to listen to you tonight. And you've also been very generous with your time to talk to my academic colleagues earlier today. So please accept this small token of our appreciation.
Thank you.
Very much.
Thank you.
Will you please join me?